Welcome everyone to our webinar today on how to structure your startup for success. So my name is Georgina Toomey, so I'm a practice group leader in LegalVision's corporate team, and I'm joined today by my colleague Dan Kim, who's also an associate in our corporate team as well. Now, before we begin, a couple of housekeeping items. So you will receive a recording and slides in your email after the session today. We do encourage you to submit your questions in the Q&A box, and we will answer them at the end. And a big thank you to the attendees today who have already submitted a number of questions, so thank you. And finally, please complete the feedback survey after the webinar as well. So also all attendees today are eligible to receive a free consultation with us to discuss how we can help you with your startup's legal needs. So if you're keen to take this opportunity up, then please provide us with your contact details in the survey that will appear at the end of the webinar. So today we will be covering the following topics. So we'll be talking about the allocation of equity as between founders when you're setting up your business. We'll spend quite a bit of time on the importance of the shareholders agreement and the key provisions that you should be considering including. Then we'll be talking specifically around protecting and future-proofing your co-founder relationships, and finally laying the foundation for growth and expansion. Now, as a sort of starting comment, for the purposes of this webinar, we are going to focus on the company structure, as this is the most common form of business structure that is used in New Zealand, and it's well suited to high growth startups with really aggressive expansion plans. So I will pass over now to Dan, who's going to speak in a little bit more detail around that company structure and also how to allocate equity as between your founders.
Okay, thanks, George. So as noted by George, the most typical structure for a business seeking future investment is a company. And so the first question would be, what is a company? So a company is comprised of directors and shareholders. The directors are responsible for setting the strategic direction of the company and holding the executive team accountable. Shareholders are the owners of the company who, as the name suggests, holds a percentage of shares in the company. The key benefit for setting up a company is that it's a separate legal entity from its shareholders and has legal capacity and powers of an individual and a body corporate. It can sue and be sued. And additionally, the shareholders benefit from limited liability, which means they are only liable to pay up the value of their shares. So the key benefits of a company include the limited liability of its shareholders. It is flexible and easy to expand, as well as providing multiple exit strategies. And most importantly, personal assets can be protected from business assets and liabilities. And there's also different sort of advantages in terms of tax planning as well. The corporate structure is taxed at the corporate tax rate, and there's an ability to manage who receives dividends. So the shareholders will typically receive after expenses, dividends from the company if the company does well. So turning to the next slide, which is to do with initial equity allocations. And the first question is that, do the initial equity allocations have to be equal? So determining the percentage of shares held by each founder is an important decision to try get it right from incorporation or right from the outset when the company is first set up. So in New Zealand, shares issued on incorporation are issued for no value and at no cost. And then following incorporation, there will always be a value attached to shares on any share issues or share transfers. And therefore, this area can be more complex to manage or correct once the shares are issued after incorporation, particularly from a tax and accounting perspective. Commonly, people take the view that if there is more than one person involved in the company, that everyone should have an equal shareholding. For example, where there are two people and two founders, that shares should be split evenly 50% and 50%. However, this is not the case, and shareholding in a company does not need to be equal. Shareholding should instead be linked to each shareholder's contributions to a company and long-term goals for the business. So moving now to examples of equity allocations we tend to see here at LV. So example one would be where two founders come together for development of a SaaS product or software as a service. Both of the founders are equally involved in the hands-on development of the product and the business operations and intend to be actively engaged in the business full-time. So in this first example, given that the contributions of both founders appear to be equal, a 50% and 50% shareholding in the company is likely to be appropriate. A different example would be that there's one founder of the business that's solely responsible for developing and has developed the product. They've already spent a considerable amount of their own time, sweat, and money into getting the business off the ground. The founder then brings on another person who they will consider as a founder going forward, but they are only partially involved. For example, for general financial or business support and consultation, together with securing contracts from some major commercial parties. But otherwise, they're not intending to be as actively involved in the business as the original founder. While both parties are considered to be founders and bring a unique skill set critical to the success of the business, it is appropriate in example 2 that the shareholding is not equal. Likely, we would see the initial true founder holding a larger percentage to reflect their heavier contribution to the business. So the key takeaway here is that each shareholder's percentage should be reflective of the contribution they provide to the company. And now I'll pass over to George to discuss the shareholders agreement.
Great, thanks, Dan. So once you've obviously determined between yourselves how you're going to allocate equity as between your founders, and we are assuming here that there's more than one founder, which is obviously not always the case, then the next key document that you want to consider putting in place is your shareholders agreement. So the shareholders agreement is basically a binding contract between the shareholders of a company, and often the company itself is a party to that document as well. As I touched on before, obviously, if you've only got one shareholder, one founder, you're not going to need a shareholders agreement, but in any other situation, it is often very appropriate and important to put a shareholders agreement in place. So in terms of what it would typically include at a really high level, and we'll dive into a bit of detail throughout this webinar on these points, but what it would normally include is provisions around how the board is appointed. It will talk to how decisions are made, what's being made at the board level, and what decisions are being made by the shareholders. It typically provides a clear pathway for when a shareholder exits the business. It can prevent the free transfer of shares. It will talk to how disputes can be resolved. It will help with the protection of the company's intellectual property, often will include restraint of trade restrictions and also confidentiality obligations. So in terms of starting to dive into a little bit more detail here, so when we talk first to the decision-making aspects of your shareholders agreement, typically it's going to provide that most of your business decisions are done at the board level by your directors. Now, within that, there might also be a list of more specific critical board matters which need to then be approved by a higher approval than your simple ordinary resolution. So instead of a simple majority approval, it might need 75% of the directors to approve those matters. Or, for example, it might be that 50% is fine, but it must include one founder director's approval or investor director's approval, for example. Now, the decisions that are going to shareholders should then be limited to only the most critical decisions. So here we're talking about things like approving a major transaction, which is, in short, a single transaction that's got a value worth more than half of the company. Or it might be that it's a decision around the company wanting to change the nature of the business or where it's going to be issuing new shares, so much more material matters. Now, one common misconception that we sometimes see is that the directors of owner-managed companies have the same voting rights as their shareholding represents. Now, what we need to always remember is the different hats that you're wearing as a director as opposed to a shareholder in this situation. Now, if you've got a company coming to you, they're owned by two founders, one of the founders, say, has 60% of the shares and the other founder has 40%. They're both sitting on the board. Now, just because one founder has got 60% of the shares, it doesn't necessarily mean that they've got day-to-day control over the business or those decisions made at the board level. And that's because both founders would typically have equal voting rights as directors. Now, that's not always the case, but it is where your shareholders agreement really comes into play in terms of how you set up those decision-making rights right at the start. So in that scenario that I just touched on, ultimately that 60% shareholder, even if they couldn't pass a decision at board level, they ultimately have the right to often remove directors from the board and control it in that way. But obviously in a two-founder company, you have to be very careful to exercise those rights. So often what we're wanting to do right at the outset is talk to the founders, get the founders agreeing exactly how those decisions are going to be made and at what level and what approval level. And effectively front-footing any potential deadlocks or disagreements in the future. Now, turning to the second key aspect of your shareholders agreement, and look, I know we've had a question come in asking around founder share allocations and how they can be prevented from being sold to third parties. This is a really key question and a really key point that we're keen to cover off here. So in terms of your preemptive rights, these effectively restrict the ability for shareholders to freely transfer their shares to unrelated third parties. So, for example, if the founder wishes to exit the business, they then have to, under the preemptive rights provisions, they have to first offer their shares to the other founders, the other shareholders to buy, before they can then sell them on to a third party. Now, for added protection, which we often, recommend is appropriate for closely held companies, is that you can overlay those preemptive rights and provide that even when they have offered their shares to the other shareholders, if those shareholders choose not to purchase them, then any subsequent transfer to a third party will still be subject to board approval. So effectively, you're enabling the board to have a final veto over who the incoming shareholder is. Now, that's really important to protect the company from a situation where, say, you've got a direct competitor buy those shares and then be privy to sensitive information shared with shareholders. Now, the next point that we're keen to talk about here are the founder control protections. Now, while initially it's likely that the only parties to your shareholders agreement are the founders as the only shareholders in the agreement, in the company, then in the interest of effectively future-proofing your documentation as much as possible, we often recommend that founders do consider building in some of these key founder protections. Now, what we're talking to here is things like potentially embedded director appointment rights. So here you'd have the founders always having the right to appoint a representative director regardless of the number of shares that they hold. You might think about requiring a founder or all founders to have to be in attendance at board or shareholder meetings in order to establish a quorum. So those meetings can't go ahead without those people present. And finally, you might want to be thinking about granting certain veto rights over critical company decisions. And again, that would be regardless of the percentage of shares held. Now, basically why we're suggesting including these and front-footing these provisions from the outset is that they're really critical to ensuring that a founder maintains control of the company and its strategic direction effectively. Leaver provisions, so these address where you have a key shareholder, whether they're an employee or a founder, they leave the company and they're no longer employed or contracted by the company. So in these cases, the company or the shareholders are able to buy back those shares at fair market value. So the buyback arrangements are also subject to vesting provisions, meaning that it might be that only some of the shares are going to be bought back at fair value, and we'll dive into that in a little bit of detail shortly. Now, the ability to buy back shares from employee shareholders is critical because often the key driver behind allowing your employees to hold shares is to drive good behaviours and high performance. Now, Typically, those parcels can be very small. And so the company may otherwise, if you're not able to buy back those shares when they leave, you might be in a situation where your cap table is looking pretty unmanageable, where, for example, you might have 20 plus shareholders who are no longer involved in the business and they hold a very small proportion of the company, which can quickly become very unwieldy when you're trying to make quick company decisions that have to go to shareholder approval. And the other reason for allowing those buyback provisions in leaver situations is that often companies will offer shares to the employees so that they can benefit from the uplift in the value of the company without capital gains as well during the period in which they're contributing to the company performance. But they don't want to see them then benefit from the gains made after they've left the company. Now, earlier I touched on vesting of employee shareholders' shares. Usually they do apply just to your founders. So in terms of, and they can obviously apply to your employees, but it would be under more of an ESOP arrangement, which Dan will talk to. So when we're talking about vesting provisions as they attach to founder shareholdings, what we're talking about here is the concept of shares being issued up front, but they're earned or they vest over time. Now, the vesting criteria can be attached to time, or it can be meeting certain performance criteria, or it could be a combination and attached to both of those hurdles. Now, vesting provisions can help incentivize really key people in a business, so a founder, to stay involved in the business and continue to contribute to its success. So by way of a very sort of rudimentary example, you might have a shareholder who is a founder, and it's agreed that 20% of their share parcel is subject to vesting. So not their entire share parcel, but just 20% of it. And it might have been decided that actually it's really key for them to be there for the first 4 years of the company because that's a critical growth period where their skills and their identity as founder is absolutely critical. So what that means is they're issued 100% of their shares on day one, but they only truly benefit from the value of 80% of that share parcel. So basically, if they decided to sell their entire share parcel straight away, they'd only get the value of 80% of it. Now, following that, then each year they'll earn an additional 5%, with them having earned the entire share parcel after 4 years. So I'll pass over to Dan then to talk to the next point around events of default.
Thanks, George. So events of default are where a shareholder commits a certain action and then that action triggers an automatic buyback of their shares. So usually these are where shareholders commit an act of serious misconduct, fraud, or breaches of the shareholders agreement. So in these situations, the shareholder is deemed to have committed an event of default and their shares are brought back at a discounted rate. So the actual discount that applies will depend on what is set out in the shareholders agreement. And typically there are two distinct pools of events of default. So the first are true events of default that the company truly wants to discourage and make sure essentially that they never happen. So these are events such as misconduct and fraud. And then the discount that applies can be anything between 20% at the more punitive end and then 80 to 90% of fair market value. The other pool of default events include matters which are not, quote, true events of default, but are still events that justify an ability to force a sale of shares. So these include matters such as death or permanent disability, where someone's enduring power of attorney gets triggered because they no longer have mental capacity to make decisions on their own, or an event of insolvency. So these events are usually included in closely held companies where the identity of the shareholders is important. In the example of a founder death, for example, it ensures that the family's estate receives full fair market value for those shares, but allows the other founders to require those shares to be sold and therefore freed up and allocated to bring on another founder. So now discussing employee share option plans. So this is where a company sets aside a pool of equity, typically around 10% for options to be offered to employees. These options are the ability for an employee to buy a share in the company and will often be used as an incentive tool for keeping employees actively engaged in the company's performance. Typically, these options vest over time. For example, 1% of options could be allocated over 4 years. So 0.25% of the share company or a quarter of those options are allocated to the employee, which vest each year. So options are offered to an employee at a price that's set by the board, and the board can be fairly flexible when determining what exactly that price is. And the idea is that employees who stay in the company over time will benefit from the uplift in the value of their options until the date on which an exit event occurs. At the point of exit, employees' options will be cashed out and they will receive the difference in the initial price against the exit value minus any tax. When including an ESOP pool, it's important to understand the mechanics of how that ESOP will operate. Often it will be critical here to also include leaver provisions in anticipation of your employees exercising their options into shares once vested under the terms of the ESOP scheme. So turning now to protecting and future-proofing co-founder relationships. So these are really critical elements to consider when setting up your business when you have more than one founder. And this is largely bedded into how you firstly set up your company. And as discussed earlier, with regard to ensuring appropriate equity allocations. And then the second key point is ensuring that there's a robust shareholders agreement in place, which includes appropriate vesting and leaver provisions. So while leaver provisions are important to ensure you're able to free up capital if a person leaves the company, they allow a company to issue further shares to an alternative person with the same critical skill set if a key person were to leave the company. Vesting provisions are the most effective method of incentivizing continued involvement and engagement by the co-founders. Vesting provisions also protect a business where multiple founders each have a different and distinct skill set, with the combination to ensure that the launch and success of their business operates smoothly, and making sure that both of those founders stick together and work through the sort of the regimen of their vesting and the time for their shares to fully vest. So typically incoming investors will look for vesting provisions as they appreciate that, especially in early stage high growth companies, the critical piece for success is the ongoing involvement of those founders. So while some founders can see vesting arrangements as negative, given that they're not fully entitled to their allocated share parcel, we actually encourage founders to see it from the opposite angle. So they're ensuring the value of their own share parcel by incentivizing all co-founders to remain engaged for the company and engaged in the business for a pre-agreed amount of time. To ensure that the vesting and leaver provisions are effective, each shareholder subject to these arrangements also needs to enter into a contractor agreement or employment agreement with the company. And these two documents are interlocked, especially with the shareholders agreement, which will contain the vesting provisions as well. So for as long as the contractor or employment relationship is in place and the obligations are met under those arrangements, the vesting of the founder's shares will continue. And then as soon as those arrangements are terminated, or an employment agreement or contractors agreement is terminated, vesting will stop. And then additionally, the leaver provisions that we discussed under the shareholders agreement will also be triggered as well. So while you can get around this in the drafting of a shareholders agreement without an underlying employment agreement or contractor agreement, these vesting and leaver arrangements are less likely to be effective, not watertight, mainly in the sense that the termination of the employment agreement or contractors agreement will seek to invoke the vesting provisions. And it's more likely to avoid any disputes as there's clear evidence that the company has terminated the underlying employment agreement or contractors agreement. The other critical piece to consider when putting these arrangements in place is to agree upfront how the value of the shares will be determined in the shareholders agreement. So often the valuation is determined by the board, who must have considered certain matters, and then only if that's disputed will the value of a buyback of shares go to an independent valuer for determination. It's important that this is clearly set out in your shareholders agreement as well. So while founders sometimes choose not to include vesting or leaver provisions, preferring to leave this instead to negotiation at the time of a key employee or founder exiting, we have found in our experience this is more likely to result in a dispute, especially where founders have, unfortunately, the business has not worked out and the founders are now butting heads. So where the business is doing well, founders obviously like to be engaged, but then when the business isn't doing well and parties are no longer working cooperatively, it's important that there's a shareholders agreement that ideally has been agreed upfront to sort of address these situations as well. So I'll pass over to Georgina now for structuring for scale.
Thanks, Dan. So the whole point, I guess, of the webinar here is to make sure that you are setting yourself up for success, and ideally at the start. So when you are structuring your company initially, and you're having your discussions with your co-founders as to those equity allocations and what you think you'll include in your shareholders agreement, we do encourage clients to consider their specific growth plans and the likelihood in particular of seeking investment in the future. Now, while typically companies will look to bootstrap their business for as long as possible, if it does have aggressive growth and expansion plans, often there is going to come a time when you need to look for external investment. Now, while it's possible to undertake a recapitalization of the company and renegotiate your governance documents at that time, often it is best and easiest to get that right from the outset, which is why we, like to have our clients informed and considering what their plans are in the future. Now, this is especially true for your governance documents, which, while they will often get renegotiated as part of a significant equity raise, your current document and the position that you take on certain key commercial matters will at least set an expectation as to the intended position between you as co-founders, with any of your incoming investors looking to reopen it, being put in a situation where they are required to justify any key commercial changes, which puts the founders in a much stronger position. Now, you should also be considering not only when first setting up your business structure, but during the first few years of operation, what those future investment plans are and what an investor might be looking to check when they're doing due diligence on your company. So due diligence basically refers to any investigations taken by an investor when they're looking into a company for investment to basically determine whether they should invest and whether there's any material risks in connection with investing in the business. So investors will typically always undertake some form of DD process before and often as a condition of investing, because they obviously want to seek to protect the value of their investment. So from a company's perspective, it's really important to prepare for the DD process before it starts to effectively make sure that completion of your funding round isn't delayed. Often, funding, particularly in the current environment, is we're trying to do it on an accelerated timetable. So to the extent that you're prepared from a DD perspective, then that makes the entire process much more smooth. Now, the level of DD that's undertaken will depend on the stage of your company. So let's start here with the example of a seed round. A seed round will typically come after both you've bootstrapped the business, so effectively your founders are funding the company from their personal resources only, and then it will come after a friends and family round where investments effectively sourced from those people that the founders have got a close personal relationship with. So what that means is effectively the seed round is often the first time, or the terms are used interchangeably because sometimes a seed round can refer to a friends and family round as well. But typically the stage of DD that we're talking to now is the first time that a company will go out to truly independent investors. Now, in our experience at that stage, your investors will usually undertake quite a high level of DD. So they'll only be focusing on the key critical matters going to the company's value. So this will normally be a matter of reviewing your cap table, which sets out the share capital of the company before and after the raise. They'll be looking at your employment and contractor agreements. So they'll be looking there that they include robust IP protections, confidentiality obligations, and restraints of trade are the three sort of key matters there. They'll typically look to make sure that each founder has signed an IP assignment deed. So this is basically saying all IP that might have been developed by the founder before you set up the company is assigned to and owned by the company. And then obviously as a final piece of DD, they'll be looking at your governance documents, because those are the documents that they will also be signing up to in their new role as a shareholder. Now, in those governance documents, your investors will typically be focused again on the IP and confidentiality protections and the restraints, but they'll also be looking to your vesting provisions and leaver provisions. They'll also then be looking to understand their position as an investor in the company, and will likely be looking to negotiate things like getting a carve out from the restraint provisions, especially if you're looking at, say, a VC who's going to habitually invest in companies and likely at times in your competitors. So they'll be looking for a carve out from the restraint, and they'll also probably be looking to seek certain veto rights over critical company decisions. So as an example there, it might be that they're looking for a veto right for when the company is trying to spend over a certain threshold of money, which effectively allows your investor to block excessive spending and provides added protection for the company, for the money, sorry, that they've invested into the company. Now, obviously, that's not an exhaustive list of items that should be included in what we call your data room, which is where you collect all your documents in preparation for DD. And the reality is often when companies haven't set this sort of stuff up in advance on incorporation, even though, you know, we strongly recommend you do, often we do find ourselves in a position where we're helping companies in preparing those documents to the extent that they are relevant in those particular circumstances to enable them to be prepared for that DD process. I guess the one kind of key flag here is it is really important to seek legal advice when you are looking to negotiate any investment documents, particularly where it includes a renegotiation of your governance documents. And also a flip side, we often focus on the due diligence investigations undertaken by the investors into the company. From a founder perspective, you also need to conduct your own DD on your investors. So what you need to be thinking about there is that these are people that are going to be involved in your company going forwards. They might have negotiated a board seat, so they're going to be sitting in on board meetings, helping you make decisions. So it is really important to ensure that you're fully aligned with your investors before accepting their money. And I guess as a kind of wrap up comment to that is that, you know, to the extent that you can make sure that you've got all of those documents in place, well drafted, you will put yourself in the best position possible, to attract investment, but also to make sure that that investment process is as smooth and as efficient as possible. And you'll also be holding yourself out to your investors as very well versed in the startup world, professional, organized, and aligned with them in terms of protecting company value.
Thanks for that, George. And so we've discussed quite a lot today, but the key takeaways for today are that there should be a really careful consideration of your business structure, including allocation of initial equity as between your founders, which is really important, with equity allocations not having to be equal as between founders. The second point is that robust governance documents should be agreed at the time of incorporation of your company, with the provisions including ensuring robust protections for your founders and appropriate provisions in anticipation of future capital raising events as well. And then lastly, keeping future investor requirements front of mind in the early stages of your business can have huge benefits in ensuring you are well prepared for capital raising, to both give assurance to your investors as to the appropriate protection and application of funds that they will invest into your company, as well as ensuring protection of founder rights and controls regardless of external investment.
Great, thanks, Dan. So look, we hope you've found that I guess the substantive content informative. Now, what we've got on the screen today is also a QR code for our publication, the New Zealand Startup Manual. So that goes into a lot of detail of some of the topics that we've canvassed today. So definitely scan that and download a copy of that. In terms of next webinar, before we get into the Q&A, so we've got an upcoming event that might be of interest to you. So that's around how to franchise your business. So that's being held on Tuesday, the 23 July at 12 o'clock. So you can register following the instructions on your screen. Now, very briefly, we just wanted to touch on LegalVision and how we operate with our clients. So basically, by becoming a LegalVision member, you will get unlimited access to our full team of 100-odd specialist lawyers for all of your business as usual legal needs. So effectively, we like to think about it, it's basically like having your own in-house counsel for a fraction of the cost. We also do offer a dedicated service for our in-house teams and general counsel to manage your sort of higher volume legal tasks. So please reach out to us, request a consultation when the survey appears at the end of the webinar, and we can talk to you a little bit or talk to you in much more detail about how our membership could potentially work for you and your business. So moving into the Q&A, and look, thank you so much for your engagement and all the questions that have come through. We are not going to be able to get through all of them. Some of them are covering the same sorts of topics, so we'll try and lump them together. Obviously, if we don't answer one of your questions, and it's probably because it's either really specific and we sort of consider it's probably better to be spoken about one-on-one, then please do reach out to us and set up that consultation and we can talk to you about it on there. So getting into the Q&A, the first question I've got, and Dan, I might pass this one over to you, is how do I set up the holding company with a board of advisors, give them equity shares without the board advisors being directors?
Thanks, George. It's a really good question that may depend on your specific circumstances as well. So the first thing is that for advisors to the board that aren't directors, you'd want to sort of put an agreement in place for that. So typically what we tend to see is an advisory board agreement as well, just so that there's a clear written agreement to capture the sort of commitments from the advisor and sort of how many meetings they'll sort of attend. So there should be that agreement in place. And then in connection with that agreement, the remuneration for the advisor turning up to the meetings will often be, yes, a form of equity. So we typically don't tend to see that equity shares are given to board advisors, but instead they're remunerated through the company's ESOP, just because this is a lot easier for the company to manage. With that being said, though, you can offer equity shares instead of going down the ESOP route as well. What you just need to consider here will be that, what is the price of the shares that's going to be offered to your board of advisors? So is this going to be done? Usually a share issue should be done at fair market value. But that being said, is it going to be more of a sweat equity arrangement where the advisor provides services in exchange for the shares? And then the last point here to consider in regard to that as well, why we typically tend to see that equity shares or ESOP options are given instead of the actual shares, is that cancelling shares or buying back shares is much more difficult to do because you'll need to go through the Companies Act requirements, whereas if they're done through the ESOP option route, it's much easier to cancel those ESOP options. So there's a few kind of things to consider here, and unfortunately we aren't able to give sort of more specific guidance than this, and it's going to depend on your specific circumstances. So this would be one of the questions that would be very much it'd be very much worthwhile to have a consultation to discuss this further, because giving away equity shares and ownership in your company is a really key decision that should be carefully considered before you go down that route.
Cool, thanks, Dan. We've had another one come in asking, do I need to register my startup business, which is at the idea stage, to get funding support to invest? So again, a really good question. I think we can get a bit distracted by, and us included, in the sense of focusing on the company route. The reality is if you are in the very early stages of developing your potential startup, your business idea, and there's not much to it, you might be working on it on the side, in addition to your full-time job. There is no issue with going ahead, and it's a low risk sort of business. There's not sort of too much to it yet. There's no issue with going ahead just as a sole trader in those early stages, while you are trying to work out what that business looks like. You're trying to develop, pre-launch, the like. However, when you are looking to go and seek investment from external investors, now obviously when that investment is attached to equity or some form of ownership in your business, then your investors are going to be looking for a separate legal entity for that investment. So effectively, it protects the value of the investment. The legal entity itself owns the business, it owns all of the IP, so they are going to be wanting to invest into that business. It obviously doesn't preclude, say, an individual sole trader from getting a loan and just simply paying that loan with interest. But to the extent that you are looking at giving away any form of equity, then you are definitely at the position where setting up a company is absolutely justified. The next one I had was that, so we've got a situation where there's 3 founders, and one has the majority of the shares and final say. How should the company be structured to give the other 2 meaningful say? So again, good question. I think my first comment there is that assuming all 3 of the founders have also got a board seat, then ultimately what you are looking to do is, at the board level, you're aiming for consensus. You're aiming to agree on all your board level decisions. Now, that's obviously a perfect case scenario. It might not always be the case, but I guess that's kind of my first comment there. The next piece is around, making sure that the others have final say. Is what you might want to be considering here is that you're making sure that between the 3 of you, you're agreeing what are the really key critical decisions that you want the other 2 to have that meaningful say in. And that is not a market standard list. That is going to be very dependent on your particular company and the strategic direction of your company. And again, you'll agree on that list, and you might say, well, actually, the other 2 have got a veto right over those decisions. So while there is one founder that has the final say, has the majority shares, can pass most resolutions, most decisions by themselves, they do need the support of the other 2 to agree those certain critical decisions. And that's often the easiest way, or most sort of effective way, to manage that piece. Looking into the other questions. Now, we've had quite a lot of questions around IP specifically. Sort of goes beyond the scope of this webinar. As you can appreciate, it's an entire topic in itself, and we do encourage you to have a look at our previous resources, previous webinars that we've done on this topic, and we'll obviously, there's obviously some need out there to do another one, so we will make sure that we do another one soon. But there is one here that I think is worth touching on. So Dan, the question is, can I start selling products with trademark application and design protection pending?
Yeah, thanks, George. It's an interesting question. So I guess as a first point of call, yes, you can sell those products with your IP sort of applications pending in the meantime. There will be, though, some sort of points to note in terms of just assessing the legal risk before you do that. The first kind of obvious point is that if you're applying for a trademark application or design protection, you won't have any sort of solid legal protection while you're selling the products until that application has been accepted by IPONS. And then it might sort of create a bit of an awkward situation in the sense that if those applications are not accepted by IPONS, you might need to sort of rebrand your product, which would be a bit unfortunate, or you might need to change your design. So those are sort of the more sort of riskier sort of approach. Or on the flip side, if it's not likely for your applications to be opposed by IPONs, then that being said, you could just, I guess, decide to proceed with selling your products with those applications pending. So ideally, this is really, it's going to depend on your specific circumstances. And these would be points that your IP lawyer raises early on when you're sort of applying for these trademarks, and sort of the likelihood that you would infringe on another person's IP rights for selling your products, even though you don't have the legal protections necessarily in place. So again, unfortunately, we can't give any specific guidance that's more sort of specific than that, and it will very much depend on your case-by-case situation. And these are, I do know that these are sort of issues that our IP team and our trademarks team regularly consider here at LV.
Thanks, Dan. And look, I know it's 12:45, so I'm just going to sneak in one additional comment, which addresses a few of the questions we've received, which is people asking around dual company structures, what they are and when to set them up. So at a really high level, a dual company structure typically is where you have a holding company that holds all of your key company assets. Now, normally that would be all of your IP and any sort of spare cash, and that's where all your capital comes in. And then idea is then you have an operating company that sits underneath the holding company, and the operating company is the one that enters into all the usual trading liabilities of your business. So that's where all the risk lies, and you've protected all your key assets at the holding company level. Now, you can set this up from the, and investors really like this structure, because obviously, again, you are protecting the key assets of the business. You're further protecting their investment. They'll invest at holding company level. Sometimes they will actually require you to set up a dual company structure as a condition of your investment. In those situations, often if you are anticipating that, then setting it up as a dual company structure right from the start is a great idea, because it's a lot easier to do pre-launch, pre-generating revenue. But again, to the kind of my earlier point around the sole trader piece is, you know, be very careful not to go down the route of what a trend is. There's also a risk of overcomplicating things unnecessarily. So if you're in a situation where actually IP is not a critical asset of your company, you don't actually have too many critical assets that are a higher risk, the business itself is not a risky business, then it might be that a dual company structure is actually just overcomplicating things unnecessarily. On the flip side, and we had a question around this, you might be looking to expand into different business arms or operations that are all related, or you might be looking to expand overseas. In those situations, often a dual company structure is appropriate. So if you download again that startup manual that we've provided, we do include a section there around dual company structures, which will give you some really good sort of high level initial information to consider going forwards. Okay, so look, we have very clearly run out of time to answer all of the questions. Hopefully we have at least broadly touched on some of the points that you're keen to have answered. If we haven't, again, please do feel free to set up a consultation with us. We're often more than happy to really dive into your specific business and try and give you some really good guidance in that initial consultation. So we do encourage you to do that. And finally, we would really love it if you could complete the survey at the end. It's just a really short survey, but it does help us understand what you're looking to get out of these webinars and continue to make them appropriate for you going forwards. So thank you very much. Thank you for your engagement, and we'll see you next time.